We have a quick question here from Tong, who asks how he can get a bond yield spread for two currencies to overlay on a currency pair chart in TradingView. He also adds that he has tried to do it, but for some reason the scale of the chart comes out all messy, and he just wants some advice on how to do it. So firstly, thanks for the question, Tong. The good news is I know, well, I think I know exactly what is causing your scaling issue. And the even better news is that it's really very simple to solve and will only take you a couple of seconds. Now, before I go into the actual chart setup, just a quick look at why we look at bond yield spreads between currencies in the first place. So firstly, what is a bond spread? Well, a bond spread simply refers to the spread or the at least in the context of FX, it refers to the spread or the difference in the yields of the same maturity for two currencies. So for example, we will look at the spread or the difference between the bond yields for, let's say, the US 10-year bond yield and the Japanese yen or Japanese 10-year bond yield when we look at something like the USD yen currency pair. If we were to say, look at the Aussie yen or let's say the Aussie Kiwi currency pair, we would look at the Aussie 10-year bond yield as well as the Kiwi 10-year bond yield, and basically the difference between those two. So why do we do this? Why do we even bother using bond yields or the spread? Well, as you know, currencies are usually correlated to interest rate expectations. And that means that if markets think that interest rates will rise, that should be positive for a currency. And if they think that interest rates will fall, that should be more negative for a currency. Now, I say usually because there are, of course, many other factors that could still see a currency depreciate even if interest rates go higher, and factors that could still see a currency appreciate even if interest rates go lower. So it all really depends on the context. Now, as currencies are generally correlated to their interest rates and interest rate expectations, and as bond yields reflect interest rate expectations, investors generally use the spread or the difference between the bond yields of various countries as a possible leading indicator of where the exchange rate might be going. So again, I just want to stress that there are many other factors that impact exchange rates apart from just the bond yield spread. So just do keep that in mind. But generally speaking, if we overlay, let's say, the 10-year yield of one currency with the 10-year yield of another, if we take that spread or the difference, especially the later duration bond yields like the 10-year, that should give us a fairly close correlation to what is happening with the exchange rate. And as the bond market is usually very accurate with pricing in turns or potential turns in overall interest rate expectations, it can sometimes act, like we said, as a leading indicator for where price might be going. A good example that I always like to refer to is actually the euro dollar. So if I just quickly open up a euro dollar chart, and let's just go to the daily, and I'm going to add in the 10-year for Germany as well as the 10-year for the US. Just add that in. A great example that I always refer to is what we saw happening to the euro-dollar exchange rate and the bond spread between Germany and the US back in 2017 and 2018. We had a massive appreciation in the euro versus the US dollar. I'm not going to go into the exact reasons why the market was moving or pricing in a higher exchange rate. There was multiple reasons for that, but what we can clearly see is from September 2017, we actually saw the bond market starting to price in. We saw the bond yield spread between Germany and the US starting to move lower. And at that same time, we had that initial move lower in the exchange rate. But as the bond yield spread started to accelerate to the downside, we had a quite steep divergence in the exchange rate to what was happening in the bond market. And in this instance, the bond market acted as a great leading and forward-looking indicator, because we eventually topped out in October or April rather 2018, and then saw a steep move to the downside, basically moving in line with what the bond yield spread has been showing all along. So always a great example of using that as a possible leading indicator. But again, it's there's many other things that move the exchange rate. It's not only that. All right, so with that in mind, let's quickly take a look at how we add this to the chart. So I'm just going to add in the USD yen because that was what your question was about. So here's the USD yen, and let's just go to a smaller time frame here. Just take the 1 hour. The time frame doesn't matter. It's just so that you can see the fluctuations more clearly. Okay, so the first thing, obviously, get your currency chart ready. So we're going to look at the USD yen, which means that we are going to look at the US 10-year versus the Japanese 10-year bond yield. Now, the first thing you want to do after you have your currency pair is just go to the compare option. So click on compare. Now, what's very, very important here is make sure that you are on the add symbol option and not the compare option, because if you compare the yield spread to the currency pair, that is usually when you get that weird mixed up scale. So let me show you what I mean by that. Let's put in US 10-year minus Japanese yen 10-year. If I add this, it should replicate the exact issue that you're dealing with in terms of that scaling issue. Right, so let's go ahead and delete that bond yield spread. Let me show you the way of adding that to the chart. So go back to the compare button. From here, go to add symbol and not compare. From that, you're going to add in US 10-year, and you're basically just going to subtract that from the Japanese 10-year. Now, also very important here to add, you're always going to, your first bond yield that you're entering is always going to be based on your base currency. So we have the USD yen, which means that the US dollar is the base. The Japanese yen is the quote, which means that we are entering or starting with our US 10-year and we're subtracting the Japanese 10-year. If we're looking at the euro dollar, for example, remember the euro itself doesn't have a bond yield. So we look at Germany. Which means that if we're taking a look at the euro dollar, we're going to start with the base, which is the euro, which means we're going to start with Germany, and then we're going to subtract US 10-year. So the first one is always going to be your base currency, right? So US 10-year minus Japanese 10-year, and if we just press enter, don't wait for the search bar to give you an option. So if you type in US 10-year, obviously it's going to give you a US 10-year as an option in the search bar. Don't wait for that to show you, the bond yield spread. It's not going to show you anything. Once you've entered in that equation, just type enter. And when you do that, it should give you that nice overlay of the US 10-year and Japanese yen or Japanese 10-year bond yield. Now, just something else also, when you do enter this, make sure that you have that overlay the main chart button ticked, because if you don't, it's not going to overlay it. It's basically going to give you a sub chart for the bond yield spread. Come on, let me just show you what that looks like. There we go. So if you don't have that ticked, it's just going to give you a sub chart. Now, if you accidentally do that, you can simply just click that and drag it onto the chart, and it should overlay it anyway. So that is just a quick video on how exactly we add that to the chart. I trust that has sorted out that scaling issue, Tong. Any other questions, as always, please don't hesitate to let us know.